Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This video is about how increasing interest rates in Canada affect variable mortgage holders who have a fixed monthly payment. If the payment is insufficient to cover just the interest on the mortgage, a problem arises for the mortgage holder. For most of 2021 and into early 2022, variable mortgage rates, where the rate is based on the rate set by Bank of Canada, were substantially lower than fixed mortgage rates, where the mortgage rate doesn't change once the mortgage starts. As a result, many borrowers opted for a variable rate mortgage. These types of mortgages now account for about 1/3 of total outstanding mortgage debt, up from about 20% at the end of 2019. In Canada, major lenders generally offer variable rate mortgages with either variable or fixed payments. For variable rate mortgages with variable payments, the size of regular payments fluctuates as the prime interest rate changes. If prime rates go up, the mortgage payment increases to cover the larger interest component. For variable rate mortgages with fixed payments, the payment amount is calculated at the beginning of the contract and remains the same for the duration of the loan term. Although the total payment amount remains constant, the interest portion of the payment varies with the prime rate, and the residual amount goes to principal. Therefore, if the prime rate rises, the interest portion increases and the principal portion decreases, while the total payment remains fixed. In Canada, about 3/4 of variable rate mortgages have fixed payments. When interest rates move, the amount of the mortgage payment does not change, but the portion going towards interest rather than principal is adjusted. But if interest rates increase substantially, these mortgage borrowers may reach a point where their fixed payments cover only the interest and not any principal. The interest rate at which this happens is known as the trigger rate. If rates rise above the trigger rate, borrowers may then need to increase their mortgage payment to cover the additional amount of interest. For some households, this payment increase may be unexpected. Interest rates have remained low since the global financial crisis, so few borrowers over the past decade have experienced a situation where the trigger rate has been reached. But with the rapid increases in policy interest rate by the Bank of Canada since March of 2022, variable rate mortgage borrowers have faced historically large interest rate increases that make reaching their trigger rate a significant possibility. Of borrowers with variable rate fixed payment mortgage, it is estimated that about 50%, or nearly 13% of all Canadian mortgages, have already reached their trigger rate as of November 2022. They need to increase their payments or talk to their banks, and these mortgages are technically in default. This is bad news for Canadians, but note that the banks may not mind and just tack on extra principal so the mortgage grows. If variable mortgage rates were increased by another 50 basis points, an additional 15% of variable rate mortgages with fixed payments could reach their trigger rate, with the total thereby reaching 65%, or around 17% of all mortgages. Certain mortgages will reach their trigger rate sooner. Those that were originated or renewed in 2021, for instance, will tend to reach their trigger rates earlier, mainly because they were issued at extremely low interest rates and often with amortization periods longer than 25 years. Canadian lenders take different approaches for borrowers who reach their trigger rates. Some lenders will automatically increase the mortgage payment so that it continues to cover the interest portion of the payment. With this approach, if interest rates rise further in subsequent months, the payment will also need to increase to cover the larger interest payments, similar to a variable rate mortgage with variable payments. Other lenders allow for negative amortization, where the interest payment is permitted to exceed the total mortgage payment. Principal payments are therefore negative, so the balance owed on the mortgage increases from month to month. Some lenders contact borrowers before they reach their trigger rate and offer options such as switching to a fixed rate mortgage or making a lump sum payment. The Bank of Canada apparently has regular conversations with commercial banks and notes that they are working proactively with their customers who have variable rate mortgages with fixed payments to determine appropriate solutions on a case by case basis. In the case of automatic payment increases, the magnitude of the change, expressed as a percentage of the original payment, depends on the current interest rate and the trigger rate. Of the mortgages that have already reached their trigger rate, it's estimated that the median payment increase would have been at most 5%, which is not that bad. This is because the typical mortgage was triggered at a median interest rate of 4.8%, which is only slightly below the rates observed at the end of October 2022, which was 5.1%. However, households that took out mortgages with longer amortization periods when rates were extremely low will have a lower trigger rate and therefore will see a larger increase in payments. For example, a mortgage originated with 30-year amortization period and an interest rate of 1.5% would have a corresponding trigger rate of 4.2% at origination, and in this case, it's estimated that the monthly payment would have increased by about 20% by the end of October 2022, which can be quite harmful. In conclusion, overall, study results suggest that a high share of variable rate mortgages with fixed payments will have reached their trigger rate by 2023. However, this does not necessarily imply that all of these households will have had to increase their regular payments as a result. Some borrowers may have made prepayments on their mortgage, refinanced their mortgage, switched to a fixed rate mortgage, or applied other changes since origination that would have prevented a payment increase. In addition, households that took out variable rate fixed payment mortgages before the pandemic have likely paid down additional principal relative to their amortization schedule, with the decrease in variable rates observed in 2020 through to 2021. As a result, the estimates should be interpreted as an upper bound of the impact of trigger rates on households. That being said, for some borrowers, reaching their trigger rate could result in unexpected increases in mortgage payments. These borrowers may need to adjust spending or use savings to meet their higher debt obligations. Households that took on a 30-year mortgage during the COVID-19 pandemic, when variable rates were extremely low, will generally see a larger increase in mortgage payments. The size of these increases will depend on how short-term interest rates evolve in the future. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.